Hello and welcome. I'm Taylor Pearson, and this is the Mutiny Podcast. This podcast is an open-ended exploration of topics relating to growing and preserving your wealth, including investing, markets, decision-making under opacity, risk, volatility, and complexity. In this episode, we talk with Benn Eifert, managing member and CIO of QVR. Ben was previously the co-founder and portfolio manager of Mariner Coria in New York, and then before that, the Wells Fargo proprietary trading desk, which became Overland Advisors. He holds a PhD in economics from UC Berkeley. This was a really fun episode. We started off talking about the history of the derivatives market and the impact of Dodd Frank legislation on the derivatives market, why some derivatives buyers and sellers are price insensitive and the opportunities that can create. And then we really started to get into the weeds on 3 different trading strategies using the Vix: Dispersion Trading, and of course, everyone's favorite topic, European dividend futures. But beyond the details, underlying all of this was Ben's unique and interesting way of looking at markets. So I hope you enjoyed this conversation as much as I did. So Ben, you've been involved in the derivatives market for quite a while. I guess maybe started to be interesting to kind of have a history of the derivatives market through sort of your lens. What do you, maybe give us some background just on how you've been involved there and kind of how you've seen the market change over that time.
Sure, absolutely. So, my background, I'm an old emerging markets macroeconomist originally. I worked for the World Bank for a while. I have a PhD from Berkeley. My first real job in finance and derivatives was on the Wells Fargo prop desk, which isn't the most famous of prop desks. The Goldman guys and the Morgan guys definitely had us one-upped on probably on brains too, but certainly on PR. But the key thing about Wells back in those days, we went through the credit crisis, and a lot of the big banks in the world were under a lot of pressure from subprime and from synthetic credit derivatives and everything. And Wells Fargo is a very conservative, backwards bank that had almost no exposure to any of the nasty credit parts of the credit derivative universe at the time. So Wells Prop actually was in a very strong position, and we had a ton of support from the bank and a huge balance sheet to work with. So we were very aggressive and very large part of the market at the time, when a lot of the other prop desks were getting downsized and their positions were getting liquidated and everything. And we were heavily involved in convertible bond arbitrage and capital structure arbitrage and derivatives trading, multi-asset class, special situations, the whole gamut. We had an active center hedging book where we, depending on what was going on in the world, we would use currency volatility, commodity volatility, interest rate volatility, all types of cross-asset class structures to customize, the exposures in the book and to overlay hedge risk exposure and so forth. And I got involved in a lot of that kind of stuff. And then really, we hired a guy named after the desk spun out of Wells Fargo into a hedge fund called Overland Advisors. A little later, we hired a senior guy named John Laughlin, who would later become my partner, but who had started and run the Blue Mountain Equity Alternatives Fund. And they were really the original pioneer of absolute return derivatives trading on the buy side in the world. It was a great fund dating back to 2004, 2005. That had been involved in all kind of things. Anyway, John had started that, and John really became my mentor in the derivatives markets, where he and I got along really well. I was the head quant and ran the quant team on the Wells prop desk. I hired a replacement to run the quant team, and I went to work for John as his sidekick. And we hired a few traders, and we kind of rebuilt a lot of what he had done previously with a new angle and combining a lot of the stuff that I had been doing, and built a derivatives portfolio and derivatives trading effort there at what was then called Overland Advisors. And John was a really, really smart guy and a pioneer in the space, and taught me a ton of what I know now. But we a few years later, we had a lot of success, and we had left to start a fund together on the Mariner Investment Group platform called Mariner Coria. based out of New York, which John and I did for about 3 years. John did it a little bit longer. I was commuting out to New York at the time every week, back and forth from San Francisco, and when I had kids, that kind of had to shut down. So I ended up coming back out here and starting QVR where we are now. But I mean, to your point about thinking about the evolution of the derivatives markets over that window of time, there have been a lot of very dramatic changes. I mean, back in the pre-crisis and through the credit crisis, and even the few years after that, the derivatives markets still had very active risk-taking participants in the forms of the big banks. The big banks had a lot of risk tolerance. They were very actively involved in position taking and risk taking on their own and warehousing inventory. There were a lot of banks involved, and banks would facilitate pretty aggressive trading from relative value hedge funds. A dozen banks would show up to make a tight market in big size and almost anything that you wanted to trade. There's a two-way market in everything and big size, and the amount of risk being on bank balance sheets was quite large. That really, and I think people think of the crisis as the catalyst for that starting to decline. That wasn't actually really true. I mean, banks were taking an unbelievable amount of risk all the way through the crisis, at the height of the crisis, and for the first few years after. It was really when Dodd Frank when the rules really started to be implemented and to bind, starting closer to 2013 and 2014, where you started to have very tight stress test oversight on banks across very detailed stress tests, drilling way down into every sub portfolio in the bank, where you started to have capital requirements tightened dramatically, intraday liquidity coverage ratios, and all of the whole kind of array of post credit crisis reforms, where regulators really looked at those big banks and thought about 2008 and said this was a systemic banking crisis that happened because banks were taking crazy risks in derivatives markets, and we just want them to stop, right? Because banks should be more like public utilities, and there's huge negative externalities when banks are blowing themselves up on the rest of the economy. And there's certainly a lot of truth to that, right? But I think to some extent, the unintended consequences, which people were pointing out at the time, it certainly wasn't a secret, but was that led to much less intermediation happening in markets in general, right? Because really the primary dealers are the biggest source of ability to intermediate markets, to take risk, to warehouse inventory when sellers show up and there aren't buyers there immediately. How to facilitate transmission and risk sharing and so forth. And so, derivatives markets started to work much more, to gravitate more to an agency only type of basis. I mean, now that's an extreme view, but, where hedge funds certainly couldn't show up and quote the kinds of trades that they used to, and the kind of risk levels that they used to, and get the pricing that they used to. That, I think, caused the overall space on the buy side of relative value derivatives trading firms to face a lot of issues. That was a difficult transition for a lot of people to make. I think you saw returns in the space start to suffer after 2013, 2014. But at the same time, there was dramatic growth in some parts of the derivatives market, driven by end users, but much more on exchanges, right? So risk was migrating away from OTC exotic types of trading by hedge funds, into equity index and ETF option trading on exchanges, where you started to see broader and broader participation in option markets, by pension funds or fundamental equity managers for hedging or for customizing different exposures that they might want, hedging out sector risk, overweight, moving quickly to overweight or underweight at the macro level. You started to see more recently heavy growth of single name option trading among retail investors. And so if you look back over the last 10 years, you've had actually very spectacular growth in liquidity and volumes on exchange in more vanilla securities, while you've at the same time had this kind of big fall off in more of the exotic risk businesses. And those still exist, and there's risk recycling out of banks, and you saw a lot of blowups in March related to that. But the fundamental nature of where the volume is, and I think where the opportunity is in the market has changed a lot over that time period. So where 10 years ago we would have been trading 90% OTC securities, tons of volatility swaps and variance swaps and dividend swaps and correlation swaps. These days, we trade primarily on exchanges using a lot of technology to drive the ability to participate in volumes on exchange, where we might run the same kinds of strategies and think about the world the same way, understand from a systematic perspective what risk exposures that we want, where we want to be short, where we want to be long, where the dislocations are, but to actually express those trades and the management of those trades in terms of, working into and out of a bunch of option positions liquidly on the exchange, as opposed to quoting banks on complex OTC structures.
Do you think it's kind of analogous to when floor trading went away and we went to electronic trading, and like you lost some, you actually quoted that when you were with the banks, they were able to put pretty tight spreads. My understanding, correct me if I'm wrong, was like the spreads may have been wider, pre-GFC, but we had more liquidity, because you had the big banks' balance sheets behind them. And now we might have tighter spreads, but, if the market makers withdraw those spreads right at the most inopportune times, it's like you said, the perverse unintended consequences. But I'm wondering how you see the trade-offs between both of them. There's pros and cons to before GFC with the banks, and then there's pros and cons now to having, even though it's liquid markets, you might still have more, dealers or market makers affecting, the movements of the markets.
Yeah, I think that's right. I mean, I think to some extent, the issues are that, spreads tend to be tighter, certainly significantly tighter than like pre-electronic markets days, right? Much tighter. Liquidity tends to be more fragmented, and there are very large volumes in the markets. But if you show up into the market with a very large order that you're trying to get done over a very short period of time, you might actually end up having more price impact than you would have earlier, right? So liquidity certainly is not just, how big is the bid offer on the inside, the four lot that's sitting on the inside market. It's, depending on who you are and what you need to get done, it's, can you move big size over some, moderately short period of time, and how much do you move markets in doing so? And I think that certainly in this environment, I mean, our view is that from that perspective, the ability to move large size over a very short period of time as a price taker is much worse than it used to be. I think we very much try to never be in that position where we're needing to go execute a large trade over a short period of time as a forced buyer or a forced seller, because it puts you in a very bad position. These days where, if you're trying to quote banks, just the markets are very wide for the size, and if you're trying to work a very large order very quickly, on electronic markets taking liquidity, market makers are going to very quickly understand what's happening and very quickly widen those markets and skew those markets against you.
That's interesting. So we've had this ongoing discussion of, is the liquidity less, or is it, algorithmic order execution that's having iceberg orders, et cetera? But you're saying in practicality, well, depending on if you're a taker and depending on how badly you need to get out of that trade, that's where you're finding the illiquidity. Yeah,
I mean, I think for us, right, what it means is what you want to avoid doing is being in a position where you feel like you need to execute a very large order over a very short period of time, right? And I think if you think about your objectives correctly, there's not that many circumstances or types of investors or situations they should be in where they actually need to, right? Very few investors actually have views that have very strong signals over the next 5 minutes, 10 minutes, half an hour, one day, right? If you're an asset owner and you're like, okay, we want to move from neutral, from neutral energy to 10% overweight energy. Do you need to do that over a half an hour? Do you need to do that over an hour? Can you do that over 5 days? Generally speaking, price impact on intelligently structured algorithmic execution programs is pretty low. So like we work into and out of positions that we want to, being best bid in the market for everything we want to buy and being best offer in the market for everything that we want to sell. And we have good systems around doing that. And generally speaking, we don't incur any transaction costs trading that way. There are obviously, different investors have different mandates and different needs, right? But I think part of it is just a mentality shift, right? It's you have a trade to put on. how do you think about the alpha from putting that trade on, the alpha from not paying transaction costs on that, and how should you be implementing that trade? Spending a lot of time thinking about what your execution setup is, and being patient and being passive in your execution, right? I think we see very large value in that.
It's interesting to think about, though, like as you think every business on the planet now, as in the digital age and in the work from home, et cetera, is like you're using fewer and fewer employees to do more and more things. So like if you think about pre-GFC, the banks and all their different separate divisions, you guys are having to do that in-house with very few employees. So you've got to get very good at coding your execution algorithms, things that probably would have been dispersed across different segments of the bank previously.
Yeah, I mean, I think it takes an emphasis on technology in your business, right? And you don't, generally speaking, if you're just trying to execute a large equity order over time without too much price impact, you don't need to start from scratch of like, how would I code a low latency DMA algorithm or whatever, right? I mean, there are good businesses, technology businesses out there that, provide the core platform that you can kind of customize to your needs. But it does mean you have to actually think about the problem that way and not just think it's an afterthought. How do I execute trades? Here's the, $500 million of stock that I need to buy. So I'm just going to kind of send that to my outsourced trader at Jones, who's just going to kind of lift the market for that and make his nickel of commission or whatever. Not to pick on Jones. They're great.
So let's go back. Like you just spoke about how the markets have changed and now we're, all these, cash settled futures and options markets. So tell us about more about the impetus for starting QVR and what your overall theme was with establishing QVR.
Yeah, absolutely. We saw, I think at Mariner Coria, which we started just as all of the changes in the liquidity environment and, bank regulations really were starting to bind. And certainly one of my takeaways from that experience was, it was getting harder and harder to do business the way that we always had, running our strategies the way that we had, trading primarily OTC, trading primarily with banks, trying to comp banks out and get into the risk that we wanted, right? There were fewer guys who would make fewer traders who would make the markets. They'd be twice as wide or 4 times as wide for a quarter of the size. And it was just harder to get risk on, harder to get, trades on at a good price. So really when we were building QVR, what we wanted to do was to really mitigate that problem, and still, talk to banks and share ideas with banks and, get color from banks and trade with banks if there was a great axe that we really wanted, but to primarily focus restructure our strategies around just participating directly in exchange volume and, having the technology to do that and the portfolio management infrastructure to do that. So it's a fairly heavy lift. It's, it was something we were able to do, and it's obviously a continuous, improvement process, but it's something we were able to do because we were building the firm from scratch. And, we could sit down and say, okay, what do we need from day one? How are we going to configure this? As opposed to, trying to troubleshoot when you have a big portfolio and you're trying to manage risk every day and you're already spending a lot of time on just, keeping things moving. So, that was really what we wanted to achieve. And, the other thing that, that we tried to do was take some of the complexity back down from what we had done historically, where a lot of the portfolios that we had run historically might have had 50 sub-strategy line items and, been to some extent culturally felt a little bit like, investors will look at the portfolios and just think this is really complicated. And I kind of just have to trust that you guys are really good. And there's something to be said for trust, of course, but I think that there's a lot of value, especially these days, the way that institutional asset owners think about their businesses. They really want to understand what you're doing and how it fits into their portfolio, how they can expect the different things that you're doing to behave in different environments, and how they might complement or anti-complement things that they're already doing. And so we really opted to start with at QVR with our highest conviction, much smaller subset of strategy themes that we thought made a lot of sense in this environment. And then to, very slowly build that out with new research efforts where it made sense, rather than running a very, very diversified portfolio across a lot of different, smaller opportunities.
As part of that, the idea of simplicity is the ultimate sophistication. It might look cool to put on 50 exotic trades, but if you can do it in the cash settled liquid markets in in a much more efficient trade that's actually a better implementation and it's kind of taking your ego out of it? Or how do you think about it?
I think it's much, simplicity. You should always do everything in as maximally simple as a way that you can that kind of meets the types of objectives and needs that you have, right? So there are times when, there are the good things about a volatility swap, for example, is that you just, if you have a clear, let's say, relative value, view, you just buy this volatility at 20, and if it realizes 21, you make $1, and that's all. And that's really, that has a nice simplicity to it at first. But like, what if it's a single name vol swap and then it actually comes with a cap, and then in a month it's an aged vol swap with an aged vol swap cap, which is actually like a really weird exotic thing. And if you want to unwind that and assign it, to another bank, you have to like get somebody to price this bizarro thing and argue over the cash flows and stuff. Versus if you're trading listed options, the complexity is around the portfolio management aspects of it. So the path dependence of listed options, right? The fact that, you're rallying away from strikes and therefore the risk dynamics of your portfolio is changing. You have to be able to manage that. But the products are very simple, very liquid. You can, if you don't like your portfolio, you can just take the whole dang thing off in a day or two. Which with a large, OTC portfolio, it's just a different world, right? So there's a lot of advantages to that.
So going back, when you blank sheet of paper, you're building QVR, what do you decide? What are the core pieces of the portfolio that you wanted to build around?
Yeah, the core pieces of the portfolio that we really started with were all, things that we had been doing for a long time in one form or another, and some of them that had to be reimagined a little bit for the current environment or for the current implementation in fixed strike. But I mean, the investment process that we run and the thought process behind it has always really been the same, and that's thinking about and understanding how dislocations arise in the derivatives market. Typically driven by, the marginal market participant or the dominant market participant in derivatives markets, who is an end user of derivatives, who isn't some sophisticated arbitrageur, is just a pension fund trying to do some risk hedging, or a retail investor trying to buy a structured note, right? The derivatives markets are a little bit different than, long short equity, for example, where in long short equity, you're trying to be the guy who's smarter than the other guy and buys the right stocks and, shorts the bad stocks. And, it's kind of a zero sum game. Like I got it right, you got it wrong, right? Whereas in derivatives markets, really these markets exist because of end users of derivatives. And in some sense, all the market impact and transaction costs that the end users of derivatives are incurring, as, in exchange for doing what they need to do, that sort of becomes a pool of alpha for relative value managers, right? And so our strategies are really organized around understanding some of those types of thematic dislocations in specific markets, in specific trading relationships, and then building a set of quantitative research around those, understanding their properties. How do you know if there's a big dislocation or not? What are the signals you'd look at? How do you understand the expected returns and the risk properties of that? And so some of the areas that we focused on early with QVR. For example, a strategy focused around identifying dislocations in short-dated VIX futures. Right, the VIX complex is a huge and highly liquid and very heavily trafficked area where most of the big transactions in the VIX market are not sort of sophisticated arbitrageurs, right? It's huge real money investors using VIX calls or VIX call spreads to do some portfolio hedging overlays, or huge hedge funds putting on directional views on volatility, just buying a bunch of puts or put spreads or something in VIX. And it's really those directional flows in the options that drive the VIX term structure. And the futures and the shape of the futures term structure is more of a reflection of that, and used for delta hedging options than anything else. And so, we run and have run for a long time, a strategy that's systematically oriented around understanding how do you know when something's wrong at the short end of the VIX term structure, when it's way too expensive and way too cheap. And then how do you take a position there and then neutralize the market beta of that position in some other market, so that you have hedged trades that aren't making or losing money based on whether the market's going up or down, but are really identifying and exploiting those dislocations. That's an example.
Yeah, I was going to go back. I've heard you use the phrase like price insensitive end user derivatives. You mentioned sort of like structured products or pension funds. But yeah, I was hoping maybe you could unpack that, because I think it's you hear that's like, why would someone be price insensitive? That doesn't make sense. But obviously, people have different incentives and things are structured. So yeah, I don't know, maybe if you have a couple of examples or just how you sort of think of that.
Sure. Yeah, absolutely. So, you think in the VIX market, for example, the biggest player in the VIX market for the last many years is a large UK asset manager that people refer to as 50 Cent, right? And they're smart guys, but their job they run mutual funds. They run equity long only mutual funds, right? And they did some work and they decided that they like hedging systematically in short dated VIX calls, right? So they just buy the front month VIX calls and they buy whatever front month VIX call trades roughly around 50 cents of premium, which is why the nickname is 50 cents, right? And it's not that they wouldn't like to pay a lower price or that they don't look and see what strike they're buying or whatever, but like what they do is they just have a simple systematic rule of thumb strategy where they're long this, they go buy every month some new front month VIX calls and they buy the ones that are around 50 cents. And if those are the 23 strike or 26 strike or whatever, or what's the shape of the term structure or what exactly is like the vol of vol, they don't care about that stuff, right? They're humongous. They have to buy, more VIX calls than God to kind of do their hedge, right? So like they can't be picky about this stuff.
And part of that too is then you think about in our space as well, you have risk transfer services, right? If you're a large Canadian pension or a superannuation fund, and the consultants have been telling you for years, you should be selling volatility, and here's a back test, and then they start coming in at large size, and they're systematically selling volatility. It's a lot of times you have non-economic hedgers, not even just price insensitive, but hedgers may have a non-economic purpose because their book is really $200 billion, and so you're looking at those flows as well, right?
Yeah, no, that's absolutely right. And that's a great example, right? Where, call overwrite and cash secure put sell strategies are very popular among, really large institutions that are very slow moving. It took them, 4 or 5 years of consultant presentations and research and everything for them to kind of get organized to put on those programs. They generally don't have, sophisticated analysis of the decomposition of the performance of those strategies and how much risk premium are they really capturing, right? A typical traditional call over rate program on a day-to-day basis is going to be dominated by the delta, right? Because you're still your long stocks and you're selling some options. And so you'll hear more academically minded people say things like, well, I mean, but people aren't dumb. Like they wouldn't, if it wasn't a good trade, they wouldn't do it. If there wasn't a risk premium, they wouldn't sell it. But like, how do they know if it's a risk premium? They look at a 30-year back test, right? And when do they update that view? 10 years later when it's a 40-year back test, right? And it's not, it's just a realistic property of the world. So every Friday or every expiration, a couple days before expiration, they come and they roll all these puts and they sell a bunch of new ones. And that's just what they do, right?
And so we talked about price insensitive or like non-economic hedgers. What phrase would you use for Asian structured products? And can you kind of tell a little bit about what Asian structured products are?
Sure. Yeah, absolutely. I mean, so in the U.S., we have this culture of retail investors owning stocks and, picking stocks and having IRAs where they, buy ETFs or stocks. That's somewhat idiosyncratically American. In a lot of European and Asian countries, you have much less of a culture of stock ownership. A lot of Asian countries, barring Japan, much less developed to like local equity markets in the first place, right? So, there's not really stocks to buy. What you have had develop over the last 20 or 30 years, among other things, are very big local markets in structured products that are, notes that have different kinds of payoffs linked to different global equity indices or baskets of equities. And particularly in the last 15 years, 13 years since the great financial crisis, we've been living in a zero interest rates world, right? So a lot of those products have really focused on, generating yield, right? So the typical product that a retail investor might buy, would be a 3-year note or a 5-year note, and it would have a 7% annual coupon, which sounds awesome, right? Because like, what the heck can you do to get a 7% yield? But the trick is the way you get it is, you get it unless or until any one of 5 different big global indices was to go down 35% from initial level. And if that happens, you're just hosed and you lose 35% and the note terminates and you're gone, right? So those kind of products are, pure play selling of long-term crash risk in exchange for yield. And these are typically super complicated products from like a derivative pricing perspective, like, way, way more complicated than volatility swaps and variance swaps, because you're talking about, it's like there's a basket of underlyings and it's going to knock out if the worst thing in the basket is down a bunch, but also, by the way, it can be called back if it's up 10% after a year and whatever. So there are these extraordinarily complex notes that obviously, I would have to do a ton of work to feel like I had done a good job valuing and pricing, and I still wouldn't really know. And the people who are buying them obviously have no idea, right? So how are you supposed to be price sensitive to is the skew of kurtosis pricing in this note correct? You have no idea, right? You just, they look at kind of, all right, I get a 7% coupon and 40% down. That sounds pretty good, right? So that trading, right? The banks go out and hedge those trades. Because banks aren't just owning the other side of the payoff when they issue those securities, right? Banks immediately are going to go out and sell that downside crash risk out in a basket of indices to hedge the other side. And so it creates these large impacts on derivatives markets because these investors are coming in and effectively doing that trade. And then the question is, how's it priced and where should it be priced? And that's certainly not a question that the investors buying those notes are really thinking about.
Yeah, that's great. So going back to you started with one of your core strategies being the hedge volatility. A lot of times we call it like an intra-market spread between S&P and VIX. We have some managers that look at that, especially just implementing that in the futures in like a short or a long trade. But I think you guys look at it a little differently, and sometimes you're using a basket of options or strips to maybe replicate that S&P or VIX futures position. Can you talk a little bit about how your intra-market spread's a little bit different?
Sure. I mean, we're in many situations, we're happy to just use the futures, but the options give you the ability to customize the payoff somewhat, right? So, a classic example would be, you can imagine a quiet but high risk premium market environment where the VIX term structure is really, really steep. There's a very large amount of carry available being kind of short the VIX term structure in the front. But things are quiet and vol is pretty low, and there's potentially outsized, gap risk where if something just totally crazy comes out of the blue and happens, and whatever, the S&P is down 10%, like that VIX future could move, massively and really outperform the beta hedge. So we'll certainly think about things like that and say, well, in that kind of a scenario, do you want to own your VIX downside risk, express the short vol view in puts or put spreads where you have limited loss and, know how much you're risking, and then have the short futures position against it in the S&P, on the long side. On the long side, usually you're not as worried about, the kind of a big negative asymmetry. Usually a long VIX futures position, of course, you can lose money, but it's usually more of a positively asymmetric, payoff profile in terms of, returns over a short period of time. So you might just hold the long position in futures versus futures.
Taylor, sorry, did you have a question about that, like short trade historically, or?
No, I was going to ask, we can sort of unpack, but I'll summarize and Ben can correct me if I'm wrong. But short, typically you're going short S&P, short VIX futures because of, again, relative value trade, you're betting on that. Those come together, or long S&P, long VIX futures. And so just to clarify.
Yeah, and the reason it's short and long, obviously, unlike if you had two stocks, presumably you'd be long one and short the other one. But there's a strong inverse relationship, of course, between implied volatility and equities, right? If equities are falling fast, you better VIX is probably going up, and vice versa.
I was thinking about trading strategies come in and out of vogue, right? Depending on what markets we're in. And part of that short trade, some people thought it was starting to break down in 18 and 19, and then just did incredibly well in March. I'm curious how you think about that as far as what's an opportune market environment, and are you toggling, based on what you view the market, target rich opportunities are, whether you're short, long, or.
Yeah, I mean that strategy, like all of our strategies for us, right? Much of the time we have no position because there's no particular dislocation in that market and there's nothing interesting to do. It's not the kind of strategy where we don't believe in general in derivatives markets that there's ever a trade you should just have on all the time, right? The world changes over time, and certainly in that, usually dislocations in large dislocations in the front end of the Vix curve are pretty regime specific. Usually on the long side, usually that VIX future only gets way too cheap on a dislocated basis, for brief periods of time, might be days or weeks or something, but usually not for, months and months on end. Way too expensive VIX futures sometimes can last a little bit longer. You can have, runs of months because there's just been huge inflows from retail into VIX exchange traded products, for example, like VXX. So back in 2012, you think of, we had a regime for a good six plus months where the VIX complex was incredibly expensive because there'd just been huge inflows from RIAs and retail into TVIX and into VXX. But generally speaking, it's a very dynamic strategy. If there's a dislocation, we like to understand where it's coming from, and we'll put on some risk. If it's a smallish, moderate-sized dislocation, we'll put on a smallish, moderate position. If it's a huge dislocation, and we understand it, we'll put on a big position. If there's no dislocation, we'll have no position. And so, generally speaking, all of our strategies work like that, where we have a suite of strategy themes where we understand the particular type of dislocation and how to identify whether it's there or not and how big is it. And we'll be allocating risk across those different strategy themes in proportion to what the opportunity set is. At a given time, we might only have, meaningful positions in 2 or 3 strategy themes out of 7 or 8, for example.
Great. Another one of your core VIX strategies you call Vix Curve, sometimes look at it like a calendar spread on the VIX term structure. Can you talk a little bit more about the Vix Curve strategy?
Sure. So, we run a term structure strategy, again, relatively systematic. There, we're looking for, significant differences in relative value in the shorter end versus the longer end of the VIX term structure, which you can get because of big inflows into, short or long positions at the front end of the VIX curve, so VIX, the front end getting very expensive in 2012 and 2016 with retail inflows, and then getting really cheap in 2017 with changes in theme of a lot of those retail flows to trying to short VIX and buy XIV and so forth. The longer end often will be more driven by there are ETPs out there, but they're smaller, like think VXC, for example. A lot of the longer end will be driven by hedging flows in the VIX options. So, big asset managers periodically will come in and do very large trades in, 6-month VIX calls or call spreads. Tail funds will come in and lift upside calls and push the back end of the VIX term structure around. And our whole modeling and thought process there is really, how do you assess the various quantitative factors that are highlighting to you potential dislocations between the front and the back, and then how do you pick a hedge ratio so that's not a 1-to-1, Vega trade, right? Because the back end of the VIX term structure is less volatile than the front, right? Typically, when vol is moving, short-dated vol is moving the most, longer-dated vol is moving less. So you have to kind of think carefully about how to hedge that kind of position.
As you're putting those trades on, I'm sure that's part of your in-house, algos and the way you look at the markets is like, are you constantly adjusting those ratios? Like there's no set ratios. It's more about what the market's giving you. And then you're thinking about how do I hedge those in a market neutral fashion? And those ratios are going to change over time. So
I would say, hedge ratios usually don't change too much for us. And that I would say if it was, so the way you're thinking about the world really is, a hedge ratio is really about risk reduction. So you want to say, what is the kind of the market neutral trade package where tomorrow, if the S&P is up 1% or down 1%, doesn't really tell me anything about whether my trade's going to make money or lose money. And generally speaking, you'll certainly get, shifts in market relationships over time and term structure dynamics, but usually they're longer term shifts. If you try to estimate some very high frequency hedge ratio that's changing a lot and very overly sensitive on recent data, it just tends to not do very well out of sample. So you'll be like, oh, I got to cut my hedge ratio. But it was really just a short period of time and some random noise, right? So it tends to be that the positions that we'll have on will be very dynamic, but generally speaking, the way we construct those trades and the hedge ratios don't tend to be highly dynamic, at least over shorter periods of time.
And when you think about that VIX curve, and you're saying the front end of that curve being moved a lot by the ETPs and retail buyers, as some of these ETPs have cycled out of existence, are you just cheering for new ETPs to come back on the market? Like, are you just you're desperate for more flows, and the ETP grows? It's just more target-rich environment.
Certainly our strategies benefit from the existence of dislocations, right? And I think we don't cheer for people to do dumb things in markets, and lose money by any means. But certainly, some of the great opportunities in some of our VIX strategies historically have been associated with very large flip positions in ETPs, both in 2012 and 2016, where ETP flows drove the VIX complex to be very expensive, and then again in 2017 and early 2018, where they did the opposite and drove that complex to be way too cheap.
Got it. And so rounding out like these VIX core strategies, we've seen before intermarket spreads and calendar spreads, but what's very unique is your Vix Basis Trade. So can you kind of talk about the Vix Basis Trade and what that is and how you implement it?
Sure. So we run. Well, if you think about what a VIX future is. The VIX itself is the level effectively of a 1-month variance swap. That's kind of what the calculation does. And the VIX futures give you a forward curve of, in some sense, market implied levels for the VIX in the future. Right? Now, those things are all very closely related to the S&P volatility surface and to S&P options. And you can, if you think pretty carefully about it, you can measure the relative value in S&P options and volatility in the forward volatility over the same kind of maturity buckets and time range as the VIX futures. And you can look at how is that basis trading, how expensive or cheap is the VIX complex to the S&P complex. And those are, again, two very closely related markets conceptually, but just from a fundamental markets point of view, they're two different markets with different sets of participants and different flows in the, at a point in time in those different markets, right? I mean, 50 Cent might be over here lifting tons of VIX calls and, pulling the front end of the term structure up in VIX and flattening it. And Bridgewater might be over here rolling their puts out from, March to June and, steepening that part of the term structure. And, these are just two big flows that are disconnected and idiosyncratic, and that'll be, widening that basis relationship, right? And so that basis relationship is, generally speaking, pretty well behaved. What range that pricing lives in. March certainly expanded our view of the range that pricing can live in. Of course, when things are really crazy, market, relationships break down and get really wide. But so we can, we range trade that basis very much the way that a fixed income arbitrage manager might range trade, cash synthetic basis relationships or something, right? Where there's two closely related things that should trade within some range to each other. When they get really stretched, you want to put on a compression trade on that basis and, warehouse that basis risk. And really it just highlights again what, the role of absolute return and relative value arbitrage managers is in the space, right? I mean, at the end, those big boys are the end users of derivatives. They're people doing stuff, from their perspective they need to do to protect their portfolio. But they're not thinking about, or just can't think about, they're too big, those relative pricing relationships. And so they create these dislocations when they come in and trade in big size. And the market needs participants that can identify that and warehouse that basis risk and try to, compress those relationships back into place.
Is part of that longer term flow would like to be the example of, whether it's a whale like a vision fund buying longer term equity replacement with calls and call spreads? Is that another example of that?
Yeah, that's absolutely another example of that. Big buying flows in long dated Vega in the S&P. That was obviously, they weren't buying VIX products, they were buying S&P products. There were other people buying VIX products at the same time, but all else equal, that would tend to, raise the price of S&P options Vega, further out the curve, relative to the VIX complex for sure. And yeah, those flows in August, that was, a very, very large end user who was very aggressive in markets and was a new participant and was, moving prices quite a lot, right? That touches a little bit on, our dispersion strategy, which is a newer strategy for us, because we didn't think it was interesting really until March. Then it got really interesting, and we spent a long time really building a great technology infrastructure to manage it. But you think of, dispersion is really all about the relative pricing of index volatility versus the components of the index and their volatility. And, when the Vision Fund was in buying huge size in Microsoft and Google and Amazon and Netflix, it was raising the price of single name volatility very dramatically relative to index to levels that we hadn't seen in a very, very long time. And it got extremely stretched. At that point, the risk warehousing, job of relative value arbitrageurs was actually to get long correlation, right? Because the effectively implied correlation had fallen to extremely low levels because index vol was extremely high relative to single name volatility.
Got it. Well, and I want to put a pin in dispersion. We can come back to it. But just thinking about all the VIX trades and the VIX trading sleeves, part of those trades that you alluded to, is there a relative value or stat arb or a pairs trade? And as you alluded to in March, those can kind of blow out on you more than you expected them to, or maybe historically they have. Is like, how do you think about managing that risk over an entire book?
Mm-hmm. Yeah, absolutely. So generally speaking, our approach to risk. So first of all, we're on a strategy by strategy basis. We're trying to construct market neutral trades, but then we're very much thinking about, the book together from a top-down risk perspective, and running a bunch of extreme stress test scenarios across all kind of risk factors, right, to make sure we understand how we think the book as a whole might behave in different environments. Now, the first and foremost thing I think that you got to do when you run a portfolio like this, to make sure you'll survive really extreme periods. It's not to have we think we have great risk models. It's not to have the slightly better risks stochastic volatility model that tells you exactly the right way that these things are going to behave relative to each other, because you have no idea, right? When March happens, even if you kind of had some inkling of how bad things could get, you had no idea of exactly what path it was going to take, exactly how different things were going to move, right? So what you want to make sure is that one way or another, you have some enough convexity in some dimension in the book that if things get, really crazy, that you're going to have sources of strength that can offset, any other potential sources of weakness that, you didn't see coming, right? So that's certainly one thing, right? And if you run, stress tests where the S&P goes down 20% in a day, or a week or whatever, with a bunch of different assumptions about what happens to the volatility surface, you'll suss out, do I really have big holes of if things go bad, go sideways, go upside down the wrong way, am I going to get smoked, right? So that's one important thing. Another important thing is really to understand positioning and, the behavior of market participants kind of in the regime that you're in. So, a great example in that, taking that basis trade as an example, in the environment pre-March, oddly enough, when the market started to sell off and volatility started to spike, most of the time in the prior few years, that basis between the VIX complex and the S&P complex would compress. VIX products would get cheaper relative to S&P. And the reason for that is, we were in a world where, especially post 2016-17, retail had discovered shorting VIX products. Hedge funds loved shorting VIX products. Lots of people liked shorting vol, and they especially liked shorting vol spikes, right? And so every time you had a little bit of a vol, and VIX products are the easiest way to do that, right? I mean, you can sell vol by selling S&P options, you can sell straddles, you can sell puts, but selling some VXX or buying some XIV is way easier, right? And way simpler from a portfolio management perspective. So we would always see that basis cheapen because you'd have big inflows into trying to sell VIX products, when you had a risk-off event. And March actually went the same way initially, where in late February, the VIX complex actually got extraordinarily cheap, and at the front end of the curve, it got just totally ridiculous, and that triggered actually our hedge volatility strategy to get very long VIX products at the front of the curve. So understanding that positioning aspect, where really the positioning risk in the market on the first leg down was market participants coming in to sell VIX and that spread compressing. So that spread was relatively wide. In the pre-March environment, we had a big basis trade on. It came in a lot towards the end of February, and we got out of that trade because everybody was kind of coming in, providing us the liquidity we wanted to get out in a hurry. And then in March, eventually, then at that point, we understood the positioning, which was hugely levered tail risk selling across the board, including in VIX products coming in early March as VIX was up above 40, and you had a variety of funds we don't need to name, but coming in to sell upside VIX crash risk in huge size, thinking, okay, this is it, right? VIX is 40, VIX is 45, it's going straight back to 10. And so at that point, the risk was, okay, this market takes another leg down and that stuff's going to explode, right? And then that is in fact, what happened. The market did take another leg down, and you ended up seeing that VIX basis explode to an extraordinarily expensive level because you had so much of that short VIX call risk that had to get covered at auction when portfolios were getting liquidated, right? So really, understanding which way positioning is, and in a bad event, which direction those basis relationships are likely to move in is really important. Like, their basis relationships over long periods of time, they're typically not directional. But at a point in time, they might behave directionally because of the nature of who the buyers are, who the sellers are, who's on one side of that basis or the other, and who's going to get blown out.
It's one thing to kind of manage that basis risk in a massive sell-off like March. I'm curious how you think about it almost on the other side of September, October, when vol's crushing back down and those relationships are starting to break a little bit. And they're kind of wonky and moving all over the place. How do you actually manage that kind of risk?
Yeah, so actually, VIX basis, that particular basis risk, it's remained pretty elevated. It's come down some from the wides, but really the way to think about it is, that basis is all about relative supply and demand in the VIX complex and in the S&P complex, right? And most of the types of funds or traders who liked to sell upside VIX crash risk and be short VIX futures, they didn't make it, right? March was rough. They're not here with us anymore, and so the market lost a lot of supply of VIX crash risk, of VIX upside calls, and of short VIX futures positions. And there's been, and VIX products have always been popular from a hedging perspective, right? I mean, you'll see investors like to go buy call spreads or calls in decent size as sort of easy to manage hedge portfolios. So that basis, it's definitely been volatile, but in general, it's kind of been high and started to come in even when volatility started to get crushed. That basis has come in, but it's been a kind of a slow and steady trend. And managing those portfolios, a lot of the work is really around, again, in the old days, OTC markets, we would have been able to trade forward vol structures in the S&P that really replicated very closely the structure of VIX contracts, but were based on the S&P and that didn't require dynamic management. And it was this kind of, as long as you could do that trade, you could just put it in the portfolio and watch it and take it off when you wanted to. Now we're synthetically replicating that type of risk in S&P with a very large number of options. And a lot of the problem of, or question of management is really managing the path dependence and higher order risks of that portfolio, making sure that as markets are moving, we're moving strikes, we're moving maturities to keep that risk exposure really well balanced.
Yeah, and you alluded to it earlier. What's fascinating to us about VIX relative value or VIX absolute return is that you can structure the portfolio market neutral, but then you're also buying cheap tail protection. And so you could still have almost like a long vol or tail risk bias when you have a market neutral book. Can you talk just a little bit how you think about buying cheap tails? Because I've even heard you say before that it's not the same as directional long volatility. Like, what do you mean by that?
Yeah, absolutely. I think often you'll hear people say things like short vol or long vol, and there's a very, very broad spectrum of things that could fit into that bucket, right? Here's an example of the distinction between long vol and long tails in an absolute return context. So one type of, we talked about Asian structured products. One type of position that we had on coming into March on the back of that flow, right? So that Asian structured product flow led to a very large dislocation where long-term index skew was way too low. And by skew, we just mean the relative price of the far out of the money puts was much cheaper than you would have expected. Usually those puts should trade at a pretty steep premium to, at the money vol, because tails are fat, right? And they should be fat. The left tail is fat. There should be a lot of skew in the market. That, deep out of the money puts should cost you some money. The trade that way, and that just came again from this one-way selling of those deep out of the money long dated puts, right?
So you brought it up earlier, and so you also look at very opportunistic trades as well, as far as different trading strategies in your sleeve that you're always tracking and seeing, is it coming back into vogue where you want to trade that strategy? And one you just brought up earlier was dispersion trading. So can you start with just a definition of what the dispersion trade is, and then why do you think it maybe in the last few years hasn't been good for dispersion, and now you think that may be coming back around?
Sure, yeah. So, correlation and dispersion, generally speaking, refers to the relationship between single name volatility and index volatility. And in particular to you can figure, okay, the index has a bunch of components and each one has a weight in the index. Okay, so Apple's a really big weight and, GE is a really small weight. And you can kind of buy the weighted basket of single name volatility and sell the index. For example, that would be a short correlation trade, and the reason is, right, the volatility of the weighted basket of names will always be higher than the volatility of the index, right? Because there's a diversification effect in the index where some names are going up, some names are going down, and so that washes out at the index level. But if you own all those individual name options, you're benefiting from that, right? As correlation approaches 1, that weighted average single name volatility will start to look almost the same as the index volatility if everything is just moving together, right? And a dispersion strategy, at least to us, so again, we're dynamic managers, we think that there can be dislocations on either side. You might want no trade. It might be that index vol is too cheap. It might be that single name vol is too cheap. And you're going to over time have different trades on depending on what's going on in the world. Now, we didn't think it was historically we've been very, very involved in that space. I would say in the old days, it tended to be the case. Let's say the 5 years after the credit crisis, index volatility, especially in the S&P, did tend to be pretty expensive. And that was because, everybody remembered how bad the credit crisis was and how bad it was to get short caught convexity or without a hedge. And S&P was the really easy, obvious go-to liquid hedge, right? So there was a lot of hedging flow going into the S&P. And it tended to be attractive to be long those component names and short the index. Now, short volatility became kind of a super popular en vogue trade across, lots of segments of the market, call it after 2016 through into 2017. And, there was a huge collapse in, term premium in the level of S&P implied volatility, not just at the front of the curve, but even kind of 6 months out, a year out. And our view was that there wasn't really any interesting risk premium left on that side of the trade at all. And if anything, you probably wanted to have the trade on the other way, where you were long the index and short the single names. But in general, we just thought it wasn't that interesting. It was over trafficked and no risk premium in 2017, 2018, 2019. You saw most dispersion strategies struggle through that period. Depended on there's a lot of different choices you get to make when you're setting up a dispersion strategy and how you run it. Some people did okay, some people didn't do too well. But in general, it wasn't a super opportunity set. I think the thing that changed that in March was a couple things. So first of all, in the prevalence of concentrated short volatility and index got blown up and went away, right? And there was a lot of hedging inflows, and at least from time to time, there's much more expensive index vol. And then on the other side, single name volatility, single name realized volatility has exploded for a couple reasons. I mean, one is you think of like the huge factor and sector rotations that we've had over the last 6 to 8 months post-COVID, right? I mean, COVID was a huge fundamental shock that affected different markets, different companies, different sectors in different ways, right? Think about like the stay-at-home basket versus the vaccine basket, and longer lockdowns. So Zoom is rallying 20% because we're all using Zoom. And then it's like, oh, we're going to go back to work, and Airbus, and we're going to start flying again. And Airbus is up 20%, but Zoom's down 20. So you had this huge realized volatility under the surface and factor rotations. And that's very beneficial for long positions in single name volatility. And then the other thing that you've had has been, large non-traditional market participants in volatility and in single name volatility. So we talked about the Vision Fund earlier, causing huge price swings in the relative pricing of single name vol and index vol. Retail has also been involved, more on the shorter end of the curve, putting Wall Street into big concentrated short option positions that they have to hedge, which creates some squeezy gamma dynamics. And so in general, the realized volatility environment in single names has been super. So now we think it's a very interesting opportunity set. It's still a dynamic one. It doesn't make sense to have a dispersion trade all the time. Sometimes you want to be long correlation because the Vision Fund has just taken it to some crazy price. But what we spent a lot of the last 6 months doing was building a technology infrastructure that could apply our approach to the markets, to dispersion, and to be able to be simultaneously out there working many thousands of option orders in low latency, effectively making markets in the direction that we're trying to get into or get out of.
I'm going to come back to that making markets, but one of the other opportunistic trades that you've had on is European dividends. What did you see this year in European dividend trade?
Yep. So, dividends are a really fun market, and it's a market I think not a lot of people know about unless you're specialized in the space, right? So there is markets globally, although historically they were biggest in Europe, where you can buy or sell dividend futures, which effectively pay you. They pay you out, they settle at maturity based on the amount of dividends paid in the underlying index by all the stocks in the underlying index over the prior calendar year. So if you buy a 2021 Euro Stocks dividend future, you just count up all the dividends that got paid in 2021 by Euro Stocks companies, and that's the settle price, right? And it's like, oh, why would you trade that? Why does that market even exist? That's weird. The reason it exists comes back to those structured products that we were talking about, where almost all of the time, when you buy a structured product that, say, pays you that 7% coupon, unless one of the underlying indices goes down a lot, the reference is always to the index price level, not to the total return series of the index, right? So effectively, there's no dividends in that product that you're buying. But when the dealers go out and they hedge the delta on the other side of that, they're buying stocks that have dividends in them. And so effectively that creates this risk to dividend exposure that banks then need to recycle back into the market. And that's what gave rise to dividend futures. And so a lot of the, they settle in a very fundamental way, right? How many dividends got paid, we count them up. And that sounds like a thing that, for guys who know balance sheets and how many dividends are these guys going to pay. But dividend futures trade in a way that's very heavily driven by the hedging of those structured product portfolios and the complicated, stuff that goes on there. So in March, you had huge blowups in the space where effectively, the French banks got long a tremendous amount of dividend risk exposure all the way across the term structure because of how fast those markets went down and how the structured products weighted average lives extend when markets go down. And the result of that was that the risk managers eventually forced the traders to hedge those positions. They sold short dated dividends primarily, which are more liquid, to hedge their entire portfolios. So effectively putting the bank positions kind of net short at the front end of the dividend term structure 1 or 2 years, and then keep holding onto those net long positions at the back because they're just too illiquid to sell in the size that they had. And we saw, and then a lot of hedge fund portfolios were taking a lot of pain and getting liquidated on the back of those moves. So, we know those markets very well. Again, we hadn't been involved the last few years because we didn't think there was anything interesting to do. But all of a sudden now there were these massive dislocations, triggered by this exotic desk hedging under stress.
Yeah, my first question, and you touched on it, would actually have been the liquidity. Obviously, this is a function of the futures indexes or not having, stripping out the dividend. So that's why all the hedging comes in. And so the index futures have a lot of liquidity, but what kind of liquidity do you see, especially like the Euro Stoxx dividend market? But I guess as a smaller player, you can be more nimble in that space. And so it's also nice that it's a capacity constrained environment. Or?
Yeah, exactly. So, they are big markets. I mean, there's, billions and billions of dollars of open interest. But that said, it's better if you are as active as we are in that market, you can't be huge. So, we might be moving, millions or tens of millions of dollars a day, in dividends futures contracts. But if you're trying to move hundreds of millions of dollars a day in dividends futures contracts, you're going to move those markets a lot. And that, which of course is what the French banks did when they had to unwind there. So you do see bigger players involved in that space, but they're typically involved in a much more static way, where they work their way into a position and then they just wear that position for a very long period of time. And in our view, that was part of what amplified the risk in the dividends market, was that there were a lot of tourists in the space before March 2020. There were big asset managers and big hedge funds that just viewed dividends as an alternative beta, and just bought a bunch of them, and then panicked and tried to sell some of them when things were going down. At the same time, the French banks were trying to sell them. So yeah, our view in general in this space is that running a capacity constrained strategy where you are nimble enough to move risk around and to be able to be in when you want to be in, to get out when you want to get out, and to be able to provide liquidity in a meaningful way when there's tons on the other side, and air pockets and liquidity, I think is the right way to be. You don't want to be so big that you end up just putting on positions and being totally stuck in them.
You've touched on throughout this conversation, from the beginning, middle, and all the way through, this idea of, part of your alphas in your trade construction and execution. And you've said before, this idea of being a one-sided market maker. Can you talk a little bit about what does that actually mean in reality, trying to be a one-sided market maker?
Yeah, absolutely. So if you think about the traditional way that hedge funds would have executed trades, and, we would have executed trades 5 or 10 years ago, you're a liquidity taker in the sense that you have a trade you want to do. Maybe you want to buy a vol swap or whatever it is. So you quote 8 banks. You say, "Hey, can I see a market in this vol swap?" And then they all come back with bids and offers, and you hope there's a good enough offer. And if there's a good enough offer, you lift it, right? And how hopefully you measured where you thought mid market was and how much transaction cost you pay. But you're removing liquidity from the market. In our case, again, where we see this growth in exchange volume and liquidity and participation, what we're trying to do is effectively put on the positions that we want and get into and get out of risk, but providing liquidity and effectively participating in that exchange volume until we built the position that we want, and then as we manage those positions, participating in the exchange volumes to do it, right? So what that looks like is we're not going to a broker and saying, "Hey, this is the trade I want to do. What's the price?" What it looks like is we are continually, we're sending out a set of orders into the market, right? Which say, "Here's what I want to buy. Here's what I want to sell." For the things that I want to buy, I want to be bid continuously, no more than 0.05 volatility points below theoretical mid-market on a real-time basis in randomized trade, batch sizes between 1 and 10 lots. Which is effectively what a market maker is doing, right? They're saying, "Here's where I'm bid, here's where I'm offered," but a pure market maker is their whole business model is that spread, right? And is trying to get hit on their bid, which is by buying below mid and then getting out of it, closer to the offer side, right? We can be better bid, than Citadel or Susquehanna on the things that we want to buy because we want to buy them, right? Because we're trying to work into a position and we want that risk, and we're in principle willing to pay up to theoretical mid-market to get it on. Whereas they need to get paid enough edge to make it worthwhile to take on the inventory, right? And what that the drawback of that, or why a lot of people don't do that, well, obviously it's a lot of work to build the systems, but also it means you don't just quote the trade that you want to do exactly how you want to do it, and then put on the whole trade all at once, right? There's uncertainty. How long is it going to take me to get into this position? How am I going to manage the legging risk getting into this position to make sure I'm not, just getting filled on all my long ball side and not my short ball side, and so forth, right? But the advantage of that is, when we do our transaction cost analysis, looking at everything that we do, we earn a small amount of money on transaction cost attribution, right? So we don't pay transaction costs; we collect them, not a ton. It's not the business. That's not how we make our returns. It's but if it was zero, we'd be happy, right? Because that means, in a world where it's expensive to transact, we're getting into and getting out of the positions that we want to and the sizes that we want to without paying transaction costs. And we're able to do that, again, by just sourcing liquidity where it's available, being bid there, not saying I have to lift the offer, but being bid there and waiting for somebody to come.
By trickling out and pinging the market like that, you got to be getting an interesting feedback of information. Do you ever put that back into your models as far as maybe we should or shouldn't be putting this position on in size?
You certainly can identify quickly when, there's a big seller in the market, for example, for something that you want to buy, right? Because you'll go out into the market and sometimes there'll be a slow trickle of fills and sometimes there'll be, a flood of fills because somebody's identified that there's a source of liquidity and they're trying to get done. A lot of times we expect that to be the case, right? Because we see a dislocation. We might not totally know where it's coming from, but we might have some idea of the type of thing that's going on. And there's a dislocation there because somebody's selling it, right? That's why it's there. That's what we expect. And so when we go out in the market to buy and we see kind of aggressive flow coming in, for sure. One area where it does become relevant, like think about dividends, for example. When we were starting to put on those positions in March, when obviously the world was very hairy and the French banks are just liquidating those positions, fire sale, and hedge funds too. Those were thin markets in that environment, and so you're very much relying on market feedback in terms of how aggressive you want to be as a buyer, right? Because if we the day that we decided to start doing those trades, if we were just really aggressive and we said, we'll buy everything that somebody's willing to buy right here, we would have bought it all and then they would have dropped another 10 points, right? What you're trying to feel for is how aggressive are these sellers? How much more is coming? You could put a 5 or 10 lot out and then they immediately hit that bid and crush it down another 50 cents. That means you want to really piece into that slowly. You want to chisel into the size. You want to see how far people are willing to sell it down. How desperate are they? And then you want to get really aggressive as soon as it feels like that's actually stabilizing. And then the massive wave of selling isn't coming anymore. And now it's like, okay, this is a huge liquidation. It went way too far, but now it feels like it might actually be done. Like, let's get aggressive. And even if then you end up coming out and pushing the market a little bit to get into your big size from that point, it's better than kind of being the guy who raises his hand and says, I'll take that trade like 20 points earlier, right?
Exactly. I get this question often from retail traders or looking to be, maybe newbie options traders. They're always like, how does somebody like Benn know where these, structural flows are coming in and everything? What are they looking at? What's on their screen? And I'm like, I don't mean to be coy, but it's like, from building 2 decades of experience and relationships with other traders in the markets at major banks and major institutions, right? There's just no other way to really get a good feel for that.
Yeah, for sure. I think a lot of that type of stuff, one is just understanding who the big participants in the particular market that you're looking at are, and that just comes with time and experience. And, and it's not, rocket science typically, because, there are very large organizations. You think back over the last, 3 years and some of the really big trades that were happening, who's doing it very quickly, because there are certain flow patterns and signatures and flow that all of the dealers obviously know and all the brokers obviously know, and there's no anonymity when you're big, right? It's interesting. People think, trading OTC makes it anonymous, or trading with a broker makes it anonymous, or whatever. It's ridiculous, right? Because when Harvest Volatility Management, back in 2018 is rolling its iron condors. It's like, well, there's one, and UBS, yes, there's only one guy who rolls 20,000 lots of 8-legged iron condors. That's UBS. And then the guy that rolls 10,000 lots, that's Harvest. And so exactly what's happening, right? And I think the same is true even in the more, the more nichier spaces when some of those exotic risk transfer trades are going up and who's positioned how. Those are just things that, you understand in the market based on, knowing all the senior people in the market and knowing what everybody's doing.
Got it. Taylor, do you have any other questions or something you want to touch on before I ask my final question?
No, take it away.
So I have a very difficult exotic hedge question for you.
Nice.
Okay. So if people follow you on Twitter, they'll understand this. Maybe this is like your Friday, trader question. All right. So my question is a bit different though. Is how do you hedge your exceedingly convex water bill if your sun keeps hosing down your neighborhood to protect the rest of the neighborhood from wildfires?
That's just theta, man. You just pay the theta, and sometimes it feels like a lot of theta, but like you got to own the convexity, and it's just worth it, and that's it. I roll that in my head. I have a mental accounting bucket for childcare costs. And that number is astronomical, and I just wall that off. I have no emotion about that, because if I think about it, it's like it's mind numbing. So if you just think about it as $1,000 a month of extra childcare costs, then it's a little easier to bear.
So it's just a pure upside call on entertainment then.
Exactly, that's what it is. It works out okay.
Got it. Ben, thank you so much for coming on. We appreciate it.
All right, guys. It was a lot of fun. Thanks for having me.
Great. Thanks, man. Thanks for listening. If you enjoyed today's show, we'd appreciate if you would share this show with friends and leave us a review on iTunes, as it helps more listeners find the show and join our amazing community. To those of you who already shared or left a review, thank you very sincerely. It does mean a lot to us. If you'd like more information about Mutinyfund, you can go to mutinyfund.com. For any thoughts on how we can improve the show or questions about anything we've talked about here on the podcast today, drop us a message via email. I'm Taylor@mutinyfund.com, and Jason is Jason@mutinyfund.com, or you can reach us on Twitter. I'm @TaylorPearsonME, and Jason is @JasonMutiny. To hear about new episodes or get our monthly newsletter with reading recommendations, sign up at mutinyfund.com/newsletter.